Businesses often need loans for various reasons, such as expansion or working capital. One way to secure these loans is by hypothecating shares. This means pledging shares as collateral to the lender, typically a bank. The borrower retains ownership of the shares, but gives the lender the right to sell them if the loan isn't repaid. This practice is widespread and legally accepted. When hypothecating shares, businesses sometimes disclose a value higher than their book value. This is because lenders often require additional security, especially for larger loans. By disclosing a higher value, businesses can access more significant loan amounts. The difference between the disclosed value and the actual book value can be substantial. Tax authorities, however, sometimes view these inflated disclosures with suspicion. They argue that the difference between the disclosed value and the actual book value represents undisclosed income. This interpretation can lead to tax demands and penalties, even though no actual income generation occurred. The taxpayer's intent is crucial in such situations. If the inflated disclosure aims to evade taxes, authorities are justified in their scrutiny. However, if the sole purpose is to secure a larger loan and the business can demonstrate this, it shouldn't automatically translate to income recognition. The Income Tax Appellate Tribunal, or ITAT, a judicial body handling income tax appeals, has recognized this distinction. ITAT emphasizes focusing on the substance of a transaction rather than its mere form. In the context of hypothecated shares, ITAT has ruled that simply disclosing a higher value to a bank doesn't constitute income generation. ITAT clarifies that income arises from actual transactions leading to profit. Hypothecating shares, even at an inflated value, doesn't fit this definition. The shares remain with the borrower, and no sale or transfer occurs that would trigger income recognition. The case of Rajesh Kumar Puglia versus ITO exemplifies this. The taxpayer had hypothecated shares at a value exceeding their book value to secure a loan. The tax authorities added the difference as income. However, ITAT ruled in favor of the taxpayer, stating that the disclosure was solely for loan purposes and didn't indicate income generation. This case highlights ITAT's stance on such matters. While accurate financial reporting is crucial, simply disclosing a higher share value for loan security shouldn't automatically lead to income addition. In conclusion, while transparency is paramount, understanding the context of financial disclosures is crucial. ITAT's approach provides a balanced perspective, ensuring fair taxation while acknowledging common business practices.